Once again, we're approaching 300 people. I really appreciate everybody taking the time. Let's just give this another minute or two before we hit go. We'll do a quick introduction of the panel. The goal today, as we were discussing earlier, kind of off the record, was not necessarily to fill up the hour, right? It was to give you 30, 45, 60 minutes of really tremendous takeaways that you could use with your clients on a daily basis, right? Because obviously it's a confusing time, and data is a great way to balance the emotional response that you're getting from your buyers and your sellers today. So that's the goal of today's event. We'll give it another minute or two. And like I said, I want to always thank Noah, Greg, and Tim for being here. Okay. Noah, are we good? You want to wait another minute or two, Noah?
Let's roll. Let's roll. I don't want to incentivize people for being late. Let's roll. Yeah.
Right. And I don't want to punish for people for being on time. So
exactly.
Let's get the 30-second intros out of the way. And I'm going to go on my screen from right to left. We have the infamous Jonathan Miller. So Jonathan, for the people, I can't imagine who doesn't know who you are. But for the people that don't know who you are, just give us the 30 seconds on who is Jonathan Miller and why you're on this panel.
Well, I think I'm on the panel because I owe Noah some money, but no. I've been a real estate appraiser for 34 years. MillerSamuel, covering New York City Metro, and I also author about 35 different market reports for Douglas Elliman around the country, and that's about it.
Awesome. Mr. Rosenblatt, Mr. UrbanDigs, tell us who you are in 30 seconds or less.
Yeah, I'm Noah Rosenblatt. I'm really like a trader at heart. Real estate was my second passion. Got out of trading in 2004, started UrbanDigs in 2005, and the goal was to create a highly customizable charting, comping, pricing, insights platform for the professional agents so that we could have a narrative and have a discussion and manage our clients' expectations with transparent and good, clean data.
Wonderful. And Mr. Greg Heym, Economist, Terra Holdings, tell us who you are.
That's it. Economist, Terra Holdings, working for Brown Harris and Halstead, love them equally. Because I know both of them have, we have brokers from both companies watching, so love you both. Been doing this a long time at Revenue before I came to Terra 17 years ago, so I'm old.
Wow. So, yeah, you're old, but I'm just curious, economist, define economist for the people watching.
Well, my mother asked me about once a month what an economist does. I think the easiest way to put it is economists make recommendations off of information. Anybody can crunch numbers, but you need a genius like an economist to actually tell you what they mean. And we look at patterns from all different levels. It's same way a broker will look at comps in a building, in a neighborhood, in a market, in a country. We do that same thing. Different levels of data will tell us different things.
Wonderful. My name is Eric Barron. I am the Chief Revenue Officer at Triplemint Real Estate. I've been coaching real estate agents for, since the late 90s. Triplemint is using data science to predict buyer and seller behavior to simply provide our agents with more opportunities. So that's who I am. I am here to facilitate, make this fun. I really want to thank almost the 400 people that are joining us right now. The goal is to spend the next 45 to 60 minutes ensuring that every single person attending today walks away with real value, right? It's an emotional time. I was talking to the guys beforehand about, the articles that are put out there that are entitled, I'm just looking down here, desperate sellers, nervous buyers, which creates an emotional frenzy. And the goal here is to learn about data, and not just learn about what data is important, but really how to add commentary to that data and make sense of it for your clients. So that's the goal of today's session. I want to thank everybody for joining us. I want to thank the panelists. And I am going to start, we have some individual questions, we have some group questions, and we'll see which way this goes. So Jonathan, you said you're an appraiser for 35 years, right? And obviously appraiser is real-time data. You're seeing, how things are going into contract on a daily basis, so it's extremely current. So since you have access to contract activity, can you add some color to the real versus perceived negotiability of deals today? That's the challenge for many buyers agents. Where is the price point? Is it 10% below? Is it 20% below? Is it 30% below? Are there really desperate sellers, as the New York Times says? So talk to us about contract activity and the perceived negotiability of the deals being signed today.
So it's important when you talk about contract activity is what does that actually mean? In other words, most of the contract activity that we're seeing within our firm, and just anecdotally, and I think the word anecdotal, and I don't know if Greg will probably agree with me on this, like most of what we're going to talk about is interpretation of anecdotal, because the data is very thin right now. And so we want to give you like a logical, like how this progresses sort of flow. And one of the things that we're seeing in most of the contract data, and this is coming through our own firm, the closing attorneys I interact with, the brokerage community, is that almost every contract that when we dig deeper still has linkage to sort of pre-COVID, like somebody looked at the property, somebody had been in the property in February and then got distracted, another deal fell through, they came back to the property and they wanted to still go in. In terms of discounting and all that, I think the implication of high or a spike in unemployment definitely has ramifications for pricing. I think buyers, we're seeing that in the appraisals going right in. However, we're seeing a lot of deals blow up, like appraisals that we've been engaged by banks, and then they just blow up. And a lot of times we don't know the reason, but I suspect in interviewing different people that that were in this is that they withdrew. They decided not to go forward. So it's a mixed bag. That being said, and in covering a whole bunch of markets around the country that have different levels of shelter in place going on, we actually, when the shelter in place rules are relaxed and brokers can physically show property and not virtually, let's face it, virtual is not replacing physical, interactions, inspections on a purchase. There's a little bit of traction on the rental, but it's still, off to the, sort of on the margin. But we're seeing in other markets, the second that there was a sort of an ability to show property, there was a sharp ramp up in two things: in new contract activity, meaning post-COVID, and then the second was there's been a real jump in new listings, because one of the characteristics, the data points, in fact, the only data point we really had in the mid-March, which is sort of the delineation of pre and post-COVID, was this drop in supply. And so I think what you're going to see going forward, and I'll sort of wrap this up, is you're going to see a ramp up in inventory, just like you're going to see pent-up demand being released. However, I do think pent-up supply will overpower pent-up demand simply because of job loss, wage cuts, things like that. But really, we don't have finality on when this sort of ends. We're sort of in this slow motion. We know we're past the apex. We just don't know. So the important thing right now in the data is to focus, when you look at deals, to make sure you understand they happen after COVID, to get a sense of if it's reflective of the market.
Do you have any? Go.
Eric, I just want to say one thing. He makes a really good point. I was looking at recent closings. I was looking at the last 30 days of closings, and of that, when were those deals signed? And I got a scatter graph that kind of ranged from mid-January to a very early March right now, with the bulk of it is kind of end of January to very early February. So if you think about it for a second, Acris is not running at full capacity. That's number one. They're only filing, a fraction of what they normally would file. But again, the deals coming in today, real time, is really reflective of late January, February. And I would agree with the delineation of COVID in mid-March. So we're a couple of months away from those true COVID deals even starting coming in. That's going to be a 3-4 month window right there once it begins.
And just to sort of add on to that, so I think you're going to have is you've had this first quarter, which in the 35 markets I cover, plus, well, essentially what we saw was an uptick. If you're in the first quarter, year over year, if you're a weak market, you were a little bit stronger. If you're a strong market, you were even stronger. It was an upward sort of movement. Or if you were a weak market, it was less weak. That there was an uptick, and I think that sort of reflected we had this huge surge, or not huge, but a large uptick, a strong spring market. And that spring market, as I like to say, has been surgically removed from the calendar. So anyway, to sort of the point with what Noah's saying is that you had this robust first quarter. I think you're going to have the second quarter is going to show horrific numbers, but we'll already start seeing some sort of uptick in activity. That
so
will
can I
be contradictory.
Quick one. So as it relates to that specific, let me just add on to this, and I'm going to throw this out to anybody. We're talking about past, right, which is a challenge for our industry, right, looking back at data. Talk to me, is there any leading indicator for data that any of you are looking at right now, right? Because you're saying we're already going to be past that. Let's talk about leading indicators that you're looking at and that agents should be paying attention to. If there's anybody that wants to jump in there, and we'll go back and forth. I think Greg had something to say.
Well, inventory is always a great leading indicator because it really tells you the direction of the market. And as Jonathan mentioned, we look at the month supply of apartments just like Census does and National Association of Realtor does with homes. The number is not that high now because so much has been taken off the market, even with the crushing to the number of sales. So I look at that, but I think the two most important things to look at right now are weekly unemployment claims, initial claims for unemployment, and when states are reopening and when, because the fact that weekly claims have been declining for 6 weeks wouldn't mean anything if we weren't reopening states, because that just means people are holding on. Maybe the stimulus is keeping them open. That's the important thing, because we could be open for business tomorrow, but if people don't feel confident about their own finances or don't feel confident the virus is contained enough, we're not going to sell anything anyway. And I think there are a handful of deals. I look at Acris data, maybe even more than Noah does, more than I like to admit. Maybe not, but there is stuff. One of the trends I see is things are going into contract the day of closing. Maybe that's just to make the paperwork easier to do, but that's what I'm looking at. Until the economy reopens and people feel safe, everything else, because the moment that happens, inventory will rise, and that'll tell us that people are feeling better about things. Just knowing when the buyers are going to come out is the tricky part.
Anybody want to add anything to a leading indicator that you're watching besides the weekly unemployment?
Well, just for me, it's how and it's really redundant what Greg's saying, but really I look at how other housing markets that are opening earlier are initially performing. And so you can see, like in New Jersey, there's been a surge in contract activity, sort of pent up demand, a lot of Brooklyn, New York City, but also other parts of New Jersey. It's not just, city to suburban. And then just around the country, other markets that are in various stages that are, maybe a month ahead of us, you can see a real uptick.
What market specifically are you looking at or two?
LA. So most of SoCal, like LA, Orange, and San Diego, is where we're seeing. We're also seeing in Florida, but I hesitate only because of sort of the SALT tax dynamic. But they were under shutdown too, and we are seeing an uptick. One of the concerns I had early on was that there would be this lull that would last 6 months, and there would just be nothing. But we're not seeing that. However, it could just be a release of pent-up demand from the fact that we didn't have a spring market. So,
I've heard the comment unemployment, and we know all unemployment is not created equal. Is there a specific, and like I say, we could move on from this, but I'll give this to anybody. Is there a specific sector that you're watching more closely than others in the employment and unemployment data, Greg? And
well, Greg.
We like to see a healthy finance and tech sector because that's where they make the most money. So we like to look at that. Obviously, healthcare is a sector that's been leading the growth in New York City. So that's going to remain fairly stable, especially during a pandemic. Wall Street, there's more and more talk now even about more technology replacing traders. And I think that Wall Street's employment never came back to pre-Lehman levels. So I look at that, and you look at the tech companies, there's always this perception that they don't have to have a footprint in New York. And now that more of them are saying that people could work at home forever, that concerns me a little, but all the major ones have made serious commitments to New York City. So that's good.
Yeah,
Noah, any leading indicator you're looking at there?
Yeah, I'm just looking at, I'm looking for three things. I'm looking for weekly new listings to come back and rise. We should be in the 500 level. We're in the hundreds, the low hundreds. I'm looking for contract activity weekly to rise. We're in the 40s. We should be in the 250s. And I'm looking for off-market weekly to go down because that's a sign that sellers are going on the market, not going off the market. I mean, you want sellers going into contract. So I think that we're kind of entering a new phase right now. I think we've kind of had the destruction of all those listings. And Greg is 100% right. You're going to see it in the inventory first. And I think Jonathan said the same thing. The inventory is what's going to show first because these sales are lagging. So all of us are looking for the same thing. We're kind of looking for that inventory to act like normal active season inventory, when for the last 8 weeks and 9 weeks, it's been just complete destruction of both of them with the shutdown.
You need a dashboard, Noah. You need a dashboard like New York State has the pause dashboard. You have to have your 7 criteria for when the market is back again, including,
I love it.
Come on and come off the market.
I want to keep it moving because Greg, you started talking about businesses, committed to New York City, not committed to New York City. So I have a specific question for you.
Sure.
Obviously, the residential sector is definitely related to the commercial sector and office and retail and business activity. Can the residential sector rebound, maintain, continue to grow with the uncertainty amongst retail and office?
Yes,
and what should agents be looking at that? Obviously we have a lot of residential agents here that don't necessarily pay attention to commercial. So is there some commercial element that these residential agents should also be paying attention to? And what are your biggest concerns?
Well, the good news is the same thing will cure all three, and that is lifting the restrictions, getting back to work, getting the economy going again, because it feeds retail, commercial, residential, all get fed from the same place. The thing about commercial is, I was asked on a webinar last week, won't this be good for the office market because companies will need more space because they'll have to distance people, right? You can't. And I said, no, because that will be canceled out by the fact that a lot of companies won't bring everybody back. I mean, the latest employment survey, almost 80% of respondents that were laid off said they believe it's temporary. There's no way that it's going to be 80%. That number would be much lower. One of the things you learn about after a catastrophe, if you think about 9/11, over 10 million square feet of commercial office space was destroyed. People thought we're going to have a shortage of space. These companies have to go somewhere. And then you realize, no, it was a recession. They said, we're not going to go anywhere. And leasing never picked up. Retail is the big unknown because nothing is more directly impacted, even once we're back to work, than any sort of retail establishments, whether it's restaurants or theaters or hotels, anything where you're facing a lot of people. But, in tourism, we were setting records every year to the tune of over 50 million people coming here a year. So I think that just like people, I live in Long Island too. I mean, there's still a lot of commuters that are going to be working in New York City. I don't know that I'm going to be in a rush to get back to my office right away, but technically I'll still be working for a New York City company. So that helps. But I'm seeing people go to parks and biking and doing all stuff. I think people are chomping at the bit to get back. And I know it'll be a slow go for a lot of people when we reopen. But I do think there are a lot of people, particularly New Yorkers, who like to prove, how tough they are, want to be out and want to be doing things again. And I think everybody knows it will come back. I mean, we've been hit with a lot of things in the last 20 years that were predicted to. No one was ever going to go downtown after 9/11, right? I mean, or you think about a financial crisis that was going to ruin the economy permanently. I think New Yorkers like that challenge. So the same thing will cure all three. I don't think there's going to be a mass exodus of companies. I think they'll be more flexible with their work schedule. And I think they may reduce their footprint over time when they can. And it's going to be hard to get long-term leases signed, which was already happening in retail, but I think in office as well.
Hey, Eric, I just want to say something real quick. You know, the fact that we're at this part of this crisis going into summer versus like what happens if this all started in September, October, and we're about to go into winter? You know what I'm saying? Think about that for a second. Like I think Greg's right, people are kind of itching to get out, and as the heat and the sun of summer come out, that itch is going to be kind of more to come. I mean, I'm hearing anecdotally, I don't know if you're hearing this, Greg, brokers are telling me that they have buyers that want to play in the game. Yeah. They want in. They just have to see the property. And who could blame them? So like we're in this shutdown. That's why I think we're going to have this like reverse checkmark kind of action where it's like destruction and then we kind of bounce back rapidly, but the bounce back is kind of halfway where we came from, and then we kind of retrace back. Because I think buyers want to participate, and Jonathan, we're tracking a market on a weekly basis where there is no market.
Right.
I mean,
right.
40 deals a week is not a market.
No.
So with the market being so thin, is it unfair then? Because obviously consumers are looking towards their real estate professional, right, for advice and guidance as an advisor. I mean, what I'm hearing is the data is simply too thin to make recommendations.
Yeah.
Yeah.
Sure. And
so I look at it from, oh, go ahead.
Yeah, you go.
I look at it sort of in a broader way. The way I look at it is we're still in this pause, and it's unprecedented, and it just is what it is, and there's nothing we can do about it until shelter in place really starts to ease and people are free to run around and physically view the assets. So the way I've been describing it is sort of, the shorter the crisis, the less damage to the economy, the less damage to the housing market, or to sort of abbreviate it, the longer we shelter in place, the less damage to the housing market is the way I think of it. Because I'm interacting with colleagues across the country, appraisers in different parts of the country, and many of these areas, you can just, they've never really done anything. And now when we're declining, they're seeing large gains. So just because you're open doesn't, to me, the biggest concern for us is think about if we went through this exact same crisis in September, October, like just, this massive spike. Do you think many businesses would survive that? So to me, it's imperative that we do it in slow motion, and that's really tough, in terms of, keeping food on the table and that sort of thing.
No, let me throw a question your way. Everybody puts out a market report. And everybody claims that theirs is the most accurate. Why do all these markets? What? No, seriously. I say that tongue in cheek.
Where's the disclaimer on any of these reports?
No, but seriously, I mean,
I don't think Jonathan puts one. I don't put one on that says this is the most accurate report, because we put the disclaimer that says you can't sue us about this report. We don't put the
right.
No, I see.
Yeah, but you tell reporters. You tell reporters you have the best.
No, but seriously,
go ahead, Eric.
Market report data, right? Whether it's a third party or an actual brokerage. Cut through the clutter here. Tell me why they differ.
There's so many little reasons why they differ.
Give me the top 5 reasons they differ. So to put some.
All right. You got cutoff dates that differ for data inclusion in the reports. Some firms will stop 2 weeks before. Some firms will go all the way up to the end of the month, has more data inclusive in it. Some firms will filter. They'll filter out the outliers. They'll filter out all the sub 200 sales, the non-arm's length transactions. You have RLS integrity issues like duplicates that are in there. You have status issues. You have supply. Let's say you're measuring supply. Do you measure everything that is active in RLS? If you do, you're going to have a lot of supply that is 2, 3, 4 years old that has not been updated in a 1 or 2 or 3 years or 8 months or 10 months. I mean, imagine a listing active where the broker has not updated it in 8 months or 10 months. There's thousands of listings that are still active like that. So, you got to have rules to clean the data and to format the data. You got differing neighborhood boundaries. When it comes to new developments, I don't have nearly as much data than Jonathan Miller or Greg Heym has. All right. I don't know if Jonathan has more data than Greg or what Element has, but when it comes to new developments, you got proprietary data that is not available that you have to collect on the side. All of these reasons, in addition to dozens of little more reasons, come into why numbers are a little different from market report to market report at firm to firm.
I think there's 2 things you have to remember that. Well, the easiest answer you could have given, no, is we don't have an MLS, right? If we had an MLS, we just all go to the MLS, pull the data, and it would all be the same, roughly. But the 2 things that I always tell reporters when they ask why there's differences, number one, we're not pretending to be government agencies. We're not the BLS, or the BEA. We're producing reports for our clients and customers. That's who the target audience is. We know the media is interested, but we do that. And second of all, we're no different than the commercial sector. You go look at an office leasing report, whether it's Cushman & Wakefield, CB Richard, whoever it is, for the same reasons Noah said. Everybody measures markets differently. What do you count? What do you don't count? And I think we're a rush to meet press deadlines. So we all know that we're missing a chunk of the data when we go to press because you're releasing things. So, we revise our data. We're all trying to get the same thing, is to be as accurate as possible. And we all, as analysts, we all look at mostly the same thing, but some of us focus on different things, and that's fine. And I think there's room for interpretation. I mean, everybody looks at the ADP employment number that comes out a couple of days before the BLS number, and they're never even close to each other.
No.
The BLS jobs number is nowhere near the household survey that Census puts out. So I think we're all trying to hit a moving target that we don't have complete data for. So.
And Greg, I think the absolute numbers are the absolute numbers are less important than the year-over-year trend, which is what most of our reports generally do converge on that year-over-year percentage change, versus say the absolute number of what the median sale price exactly came in at, for example.
Yeah, the trend is your friend until it ends, and I totally agree with that and everything that's said. One of the things that I've learned doing this the reports for about 25 years, and Greg has a similar history with it, is that public record here sucks. I mean, to put it lightly. And public record, when you solely rely on public record has issues like the data, as Noah was saying, the data's slower coming out now. We had a period 5 or 6 years ago where the data from Staten Island or the data from Brooklyn or co-ops being reported like 6-month backlog, like crazy variation. So if you're only looking at one source, you're more vulnerable. But if you add more sources, there's more variables, right? So you have to sort of navigate this path. And really it all comes down to, is the trend telling you the story? And also too, and I'm sure everybody here would agree, that sometimes the data, and we're going to see this in the second quarter, that the data isn't matching the narrative on the ground because of the lag. And one other thing is that we've learned in this cycle that contract data is a lagging indicator. Like, if you think about the meeting of the minds between buyers and sellers, and the broker facilitates the negotiation, they come to price and terms, you're taking a 2 to 4 week lag before the contract is finished by the transaction attorneys, and then it becomes a written deal. And it's not like right fresh off the presses, so to speak, and that varies depending on market conditions.
So I hear all this. I hear all these challenges, right? I mean, I would assume that MLS is not a magic bullet. The data's integrity is only as good as how it's inputted. and updated, right? It's like any CRM we all have challenges with about data integrity. So put on your agent cap. If you had a favorite piece of data that you're going to talk to your consumers about, what is your favorite piece of data, and how would you share that information? Like, be the agent for a second, not the data scientist.
Months of supply for me.
Say it again.
Months of supply.
Months of supply. Why?
So number one is that pricing trends are a lagging indicator. In other words, as Greg said earlier, inventory, sales or contracts are in the front of the sort of trend, and pricing is the smoke, or after the smoke settles, what the residual is. And what I like about months of supply is it's the interaction of supply and demand. In other words, how much, how many months would it take to sell off all active supply at the current rate of sales? It tells you the speed or the pace of the market. And the reason why that's important is because, like, for example, in 2004, as we're like the prices are skyrocketing, it's the bubble. And if you just looked at sales, they were just straight up a rocket ship. If you looked at inventory, it was a straight up rocket ship. So if you only looked at inventory, you'd say, wow, inventory is exploding, but it just happened that sales were overpowering it. So I've always looked at the interaction as a very powerful tool in terms of the trending, where things are going.
Hey, Eric, I want to chime in on that real quick.
Hold on. I want you to talk like you're an agent to a consumer, really. I mean, it's the average agent watching wants to be able to tell a very simple story about your favorite piece of data and why.
Yeah. So, I mean, I'm a little biased. I mean, I have UrbanDigs, but I have the market pulse, which as Jonathan says, it's a ratio of supply and demand. So it does that interaction for you. What I like about it is both supply and demand are daily updated. So somewhat real time kind of looks. And it tries to offset each other and give you an interpretive index in terms of is leverage on the buy side, is leverage on the sell side. I think it's very easy from a consumer standpoint to look at it. As it rises, the market's getting better, and as it falls, the market's getting worse. And I also I love listing discount. I love negotiability. I mean, because I think everyone wants to know, both buyers and sellers, is how much am I going to have to negotiate? So listing discount is one of my go-tos to kind of sense. It is lagging. It is going to be a rear view mirror, like Jonathan said. It's going to be the smoke. It's going to reflect what really happened 4, 5, 6 months ago. So in that sense, it sucks. But I kind of use the market pulse as my gap to bridge the real time and the lagging closed.
Greg?
I would say inventory, and as a broker, I would tell my clients, this is the most objective, real-time, and forward-looking indicator that we have. No is correct that, depending on how you look at it, you could be looking at stuff 2, 3 years old. But the vast majority of it is on the market, is being updated. You look at that, because at the end of the day, if you're a buyer right now, you think you're going to be, especially if you're paying cash, you're going to be a king. But if there are only 5 apartments that meet your criteria, then maybe you can't get the same kind of discount. And I think it can't be disputed that you're limited. You can only buy what's being marketed. And demand is hard to measure. I would say we could look at the job losses and what the stock market is doing to get a gauge for if people have more money. But it's really going to be hard to measure demand for people to go see apartments, because that's going to be a slow comeback process. So I always tell my brokers the only real fact, and I would tell my clients if I had any, were the only fact we really know is what's for sale right now. And that's not going to change today, and I think that's the best you can do.
Real quick, Jonathan, I've heard a bunch of agents asking, like, how the heck is an apartment being appraised today, right? You have your general guidelines of going back the last 3 or 6 months. You're looking for sales in a building. What's a comparable today? Just give me the short answer on, some brokers are panicked, like, how is anything going to be appraised in this market with potentially some of the restrictions or other requirements that banks may be looking for to protect themselves on the downside? So, and I know you talk to other appraisers in other markets. So what's the consensus there from an appraisal point of view in regards to the current data?
Right. So first of all, the banks, unlike the financial crisis, are actually are doing what they're supposed to do, which is sort of risk mitigation. that they're not being stupid like they were in the last cycle. So that is good news in the sense that after we get to the other side, that I'm hoping we don't have a banking crisis. I mean, if we do, it's something that we're not quite seeing yet. So that being said, when we do the appraisals right now, we don't have data really that's current post-COVID that is not linked to the prior condition. So essentially what we're doing, and this is how the banks are generally handling it, is it's not my business to make some random adjustment. Hey, I talked to Joe and they're doing percent in Brooklyn and they're doing, we're not adjusting for that yet. We're just putting a big caveat. The lender is mitigating the risk now by mortgage rates on the jumbos are not nearly as low as they could be because the lenders are enjoying the spread. You're on lower, like the LTV situation is, a giveaway, and credit score requirements are higher. So what we're doing, there's other things we're doing, but it's like, that's not your question, but the thing is that we don't have data.
That is my question. I'm an agent. Is this apartment, house, home ever going to appraise given the current market conditions? Is the answer?
The answer is yes, with an asterisk. I mean, that's how it is right now because there isn't data. I can't say, we call it time adjustments. Like, is the market compared to 6 months ago, is this not the market, but is this specific property less or more, right? And we can all prognosticate and say, yeah, it's, market's terrible, right? It's it has to be worth less. But we're seeing deals closed. They're linked to pre-COVID. I'd say anecdotally, half the deals that I'm talking about to attorneys, there is no discount. It's just a miracle that they got it closed virtually. So I can't sit there. It's irresponsible of me to make some random adjustment with literally no data to be able to do that. It's one thing to have 4 sales in Brooklyn go to 10% drop, right? But they're not even comparable to my property. How is that valuation? But you bet we're going to talk about that in the report, but that's an underwriting decision that they have to factor in right now. And there are closings that are occurring on appraisals that we're doing with those types of disclaimers.
So Jonathan, are you saying that basically you're considering a stable market until the closed data at a lag finally comes in which time it might reveal itself as a declining market, but that won't be until 3 months or 2 months or whatever in the future?
That's certainly possible. I mean, one of the things that came up out of Washington with FHFA is that they did this because they're trying to keep the liquidity going in the mortgage market, is they basically allowed to defer, not waive, but defer appraisals for like 120 days or 90 days. I forget what it bounced around a little bit. So think about that. You're going to close a loan with no valuation. You don't even know if it's, you have no idea, right? And then you're going to give me a call 90 or 120 days from now, and I'm going to have data by then, and I'm going to say, well, that $1 million property at the time was worth 800. So it's this weird small moment in time where the lack of information, the lending community is trying to keep the process going through other types of risk mitigation.
Okay, so I have like 3 or 4 questions here that were general questions. I'm going to just kind of put them all on the table because I also want to save a few minutes at the end for a little rapid fire. And I really want to put some of your answers in perspective once again in agent speak, because I know agents are always, they typically walk away and go, oh my God, that makes, sense, but how do I put that in my own words? How do I add my own commentary on it by still delivering accurate information? So, I have questions here that talks about, what story does the data not tell?
Right.
And we kind of covered that a little bit because most of these indicators are lagging. We talked about what other data than real estate data are you looking at? I know Greg's looking at the unemployment data. Are there any other data points that we should be looking at other than real estate data? if anybody wants to chime in on that. And
well,
why?
I think for the customers, for your clients to come back and buyers to come back, you want to be, the stock market there's this misconception that we follow the stock market in perpetuity, and it couldn't be more incorrect. And all you have to do is look at the last decade to see, and I know Noah can speak to volumes of this because he's analyzed statistically both. One of the reasons the stock market has been on this great run is because it's had corrections and people have had opportunities to buy in. We haven't had that up until recently, and that was the bummer about this, is we had the correction and we were flying the beginning of this year. It looked like this was really going to be the comeback year of the market. So I like to look at stocks because it's the best mood ring out there that you can find. And we don't necessarily track jobs because people buy large apartments not because they just got a new job. I mean, let's be honest. But you do want the health of the city. And I think the other thing that you should track now, and it may be as important as anything else, is the legislation that is going to try to be pushed through in New York City and New York State to raise taxes on everybody possible, whether it's a Pieditary tax, a Millionaires tax being increased, because that is really scary for the future of New York. When you have, SALT's already taking buyers away. No one's going to move here full time and buy luxury apartments unless they really, really want to do that. We shouldn't be scaring away the other buyers who want to have a second home here. So I think you have to keep an eye, because a lot of people were blindsided by rent regulations turning out the way that they were. And that surprised me, because if you were paying attention, you would have noticed that, the same party was in charge of all three important bodies in Albany, and there was nothing to stop that change. So that's another thing I look at. Maybe it goes back to my revenue days and, work I've been involved in the last couple of years, but you really have to look at the tax climate. And also, we've sent it, everybody's mentioned the Amazon deal. That sends a very negative message to businesses that we can make a deal with you and then basically blow it up. And I don't think we want to send that same message to people that want to own a home full of part-time here, because that really is not good for our future.
Other data points, Noah, you're looking at?
Yeah, I mean, look, I love the stock market as a mood ring. That's a great way of looking at it, because I mean, people look at the stock market like it's the stars, and in mid-March, the stock market was at its depths of hell. March 23rd was its low. I kind of think that if you had an accepted offer around March 23rd and March 24th and March 25th, you probably nailed like the low. I mean, the seller probably hit that gap down bid. I love looking at credit spreads, not credit markets, credit spreads, taking a look at the corporate bond yields versus 10-year treasury yields and seeing that spread and whether or not it's widening or narrowing.
Put that in 30 seconds of layman's language.
It's just measuring whether or not the credit markets, those short-term markets that the Fed had to come in and put about $2 trillion into, those, that little $2 trillion, that's to finance the commercial paper market, the short-term treasury market, the money markets, all these short-term financing vehicles. When that goes kaput, the whole system goes kaput. So that's why the Fed came in and kind of saved it, kind of backstopped it. So I like to watch credit spreads because it will tell you if that's getting a little worrisome, and that may tell you like it's a risk-off kind of tone. But then look, I mean, then you got real-time stuff like restaurant bookings and credit card transactions and payment. People are looking to see activity come back in social life. People, they're looking for any type of metrics that people are going back. I mean, there are guys that knows there's a lot of money at stake here. And whether they're trading the stock market or they're going to invest in real estate, if they can find when the activity, because we're coming back from nothing. Like we've had the extreme, everything is shut down. So there will be a bounce. If you play it right and you get the narrative right and you manage your expectations right, you will ultimately have data to say, oh, look, we're rebounding now. Let's get back into it. And I think that's when the herd-like mentality will start to come out, but it'll be slow to start. But the people that are looking to put big money to work are looking for any indications that activity is coming back. So that's why I say restaurant bookings and credit card transaction payments, stuff like that.
Well, most controversial piece of data that you've seen people use, particularly periodicals, right? They like to make broad sweeping claims, which is fine. What is the most controversial and debated piece of data that you've seen?
I have one that I really hate, and that's the Case-Shiller index. I really hate that. It's a repeat sales index where they do have a condo index, but the New York area numbers cover parts of 4 states. It is incredibly misleading and very lagging when it comes out. I don't like when people don't have, I mean, New York, we all think our markets are special, but I don't know, when you don't include co-ops in your data, which are,
It's just single family, right? It's silly.
they have a condo index, but when it includes New York, New Jersey, Connecticut, and Pennsylvania for some reason, I don't know what good any of that information. And as I know, I get a lot of emails from my brokers, and I'm sure you guys do too. Buyers will throw that in your face, saying, "Well, you want me to pay full ask? Case-Shiller is saying that prices are doing this." I really don't like that, and I'm not a big fan of indexes, except the consumer price index.
Nowhere, Jonathan, real quick, the most controversial piece of data, or as Greg said, most piece of data that you hate.
Right. So the first thing is Greg's comment, just like totally on board with Case-Shiller. I think I just have made a living off of criticizing it, and it does lag the market by 6 months, 5 to 7 months. So the Case-Shiller numbers that are going to come out this month actually represent Christmas, just for context of how much they lag the meeting of the minds between buyer and seller. It's preposterous. The data point that gets me, although maybe not as much now because I like to chart it, is the sort of record sales. Like, here's a $50 million sale, or here's a $100 million sale. Here's a $238 million sale. This means that the whole market is fantastic because we have this $238 million sale that sold 5 years ago. And it doesn't. Like, it's just one tiny niche and has nothing to do with a 1-bedroom tenement on the Lower East Side. It's just silly. And that is a constant piece of data that's always flouted in the market.
Yeah, for me, I would say median sale price. I don't like it. I don't like it. I don't look at it. I look at price per square foot for my linear price action kind of trend. It's kind of, I break things down on a monthly basis because everyone wants real-time kind of information. So we do it monthly rather than quarterly. And I find that median sale price is more of a function of what types of properties close and when. You could have 1 month where it just happens to be a lot of studios, 1-bedrooms and 2-bedrooms. And then the next month, there's a bunch of new developments that close and there's a bunch of townhouses that close. And the prices just go very volatile. And especially like a hyper local market like Manhattan, where agents are trying to customize down to like the Chelsea 2-bedroom co-op market, median sale price. You look at those charts and it's going to be kind of like a mini EKG kind of thing. It's hard to read is all.
Yeah, but also just to add to that though, average and price per foot do the same thing. So the problem is, so the way I've approached it, I don't disagree with you. Like, all these metrics are problematic. So to me, when you look at them side by side, they tell the story, or help tell the story. Like, if median is flat and average is up, whatever. Like, there is no absolute sort of trend number that you can sort of hang your hat on. And so for the agents out there, I think median generally and price per square foot a close second would be the two ways to look at it, and average is completely to be ignored.
Okay, so real rapid fire here. We got 8 minutes left. I got to leave like 4 minutes for the rapid fire round, so I got like 4 minutes here. I need some predictions, right? I mean, agents are always asking because they're getting asked by their buyers and sellers. Are we talking 5 or 10% negotiability? Are we talking 10 to 20% negotiability? Are we talking a bigger difference between resale and new dev? Are we talking a bigger difference in price points? I know it's not an exact science, but our agents get asked every single day. So, and I know you want to give me a range, but you still have to have an opinion. And I'm going to force you to have an opinion, and hopefully you'll answer this question. Talk to me. Are we talking about 5 or 10%? Are we talking 10 to 20? I've seen offers come in 30% below. Give me some numbers and tell me why in literally a sentence or 2 or 3.
Who do you want?
Noah.
I think if you're going to, at the end of the day, if you do a median, and let's say you take the pre-COVID peak number and you go to the post-COVID bottom number, whenever that may be, August, September, October, I think you're going to see a down 15 to 20% print. in terms of median sale price and price per square foot. And the reason I think you're going to see that, I think it's going to be fast. I think it's going to be swift. I think the next month it's going to bounce right back, and then it's going to kind of come back. I think it's going to be a very small moment in time. And my logic, my rationale behind it is think about all of the contracts signed in mid-April to mid-May or now that ultimately is going to be the only deals that populate September or August or September's months of data. So instead of 1,000 deals being signed in a normal market, you're going to have 100 or 150, and those are going to be COVID deals. So now we're looking at the listing discount and we're looking at the price. I think that low volume, minimal volume month is going to, again, show the destruction. But again, who took advantage of it? Hardly anyone.
Okay. Jonathan, Greg, who wants to go? Hop in.
Well, so I'll say this is that in prior events, Lehman, we saw 30%, within a 6-month window on the resale market, filtering out new development because there's a time lag for contracts. Yep. And so what I hate is to be sort of forced into proclaiming that 30% in aggregate apply, is it 10, 15, 20? Is it 0? My problem is that because of the unemployment situation, I think we're going to be really surprised because most of the unemployment is heavily skewed towards hourly wage earners, the gig economy, and independent contractors, putting the brokerage industry aside. And so it's totally distorted. So like when Noah says what he's saying, I don't disagree with anything he's saying, but it's as if the market is like, our studio's going to do the same thing as 4 bedrooms. And I don't want to be in the position of just BSing and saying, boom, it's this one number, because everybody wants that magic number. And even you're rightfully saying the brokerage community wants to know what that number is. And I contend there is not a number. It's very specific. And I don't want to be cavalier about it. That's
okay.
That's
okay, so what's the number?
So I waited to go last so I could hear it. Now, I'm gonna say the number is 0, and I'm gonna tell you why. First of all, you cannot go back to prior events and price anything.
Right.
It's unnecessary step because everything is different. The other thing is we already had a price correction. That shaved up to 20% to some segments of the market in value. Exactly. And the thing I say to my brokers that I speak to, and I would say to all the brokers on here, don't bet against yourself. Like, if you go to a salary negotiation and you want $100,000, you don't go in and first say, I'll take 90 or I'll take 80. I think that it's going to be the same problem after Lehman Brothers. When we bottomed in March of 2009, along with the stock market, the problem was there were no comps, right? And we know that's going to be even worse this go round because sales aren't down 50% like they were there. They're down like 80% now if we look at contract signings. So don't negotiate against yourself. Look at the new stuff coming on. The broker's job has not changed. You have to look at your competition and get below it. And I think that's the same advice that we've all probably been giving people for the last 3 years. And where the bottom is, it is. But this idea that you can just chop, I love analytical data, and we have analytics programs that we use, but it is a terrible way to price things in a changing market. And anybody that tells you a number, remember the numbers that were thrown out after tax reform? People said 10%, 15%, 20%, all nonsense.
Yep.
Sorry.
Oh, hold on. So we got to do rapid fire. It's funny. I want to almost have another debate about this because, obviously one of the things I've been looking at with my company is, future behavior. And I know, how can we add future buyer and seller behavior into this bigger discussion, to arm our agents? Because every other industry is doing it. We're just the only industry that has, failed to catch up with, Google knowing you're pregnant before you do. So I think we should all talk about, how we're going to, look at the future of buyer and seller predictability. So that'll be round 2, but lightning round, literally 30 seconds each. Biggest mistake agents are making when interpreting data is? Noah.
Agents' biggest mistake when interpreting data, I would say, is Most people do not go back and review what the previous cycles were to find out what's normal and what the trend is. So, for example, if you're looking to analyze where we are right now in supply, you're going to see something very abnormal. If you go back to last year, what do we normally do? Go back to the year before, what do we normally do? Look back to see what is typical for that period of time in prior years. See what's normal before you look at where you are now, because otherwise you're not going to know where you're coming from.
Okay, Greg, biggest mistake agents make in interpreting data?
Assuming all segments of the market behave the same.
Ooh,
Awesome.
Good one.
Love
Good
it.
one.
No, Greg followed the rules.
I'm an economist. I do it efficiently.
You had a better answer than I did. That's all.
Jonathan, come on, we got two. I got one or two more. Jonathan, biggest mistake agents make in interpreting data?
Is that they cannot separate themselves from the market, that there's cognitive bias, that they need this to happen, and so it impacts their neutrality in terms of how they price a property to sell.
Okay. Without just putting the general comment that we're all going to be great and New York is resilient and putting just a blind optimistic point of view, what are you legitimately optimistic about right now? We'll go last to first. So Jonathan, what are you legitimately optimistic about right now?
That there will be a surge in activity fairly immediately after the shelter-in-place rules are eased, that people are not going to be paralyzed, that they're going to move out and look.
Greg.
People's needs haven't changed, and that's good for us. They need apartments. They need to buy, sell. That hasn't changed.
$6 trillion in stimulus here, 13 trillion in global stimulus and growing. That makes me think there will be a reflationary wave.
Wow. Okay. Final question. This could be anything. We'll still go reverse roll again. Noah, what are you binging on right now?
TV shows?
Anything. It could be a pack of Oreos. What are you
I just
binging
finished.
on?
I just finished Fauda on Netflix, which is like an Israeli-Palestinian counterintelligence show with 3 seasons, and it was pretty cool. And right before that, I did Narcos, and Narcos was awesome.
Greg, what are you binging on?
I'm binging on guitar. I started taking jazz guitar lessons at the end of last year, and after almost 40 years of playing, I realized how little I know about the damn instrument. So the virtual lessons are keeping me sane.
That's awesome. That's awesome. Jonathan?
Mine is buying T-shirts online. For causes.
I thought you were weird before, Jonathan.
Yeah. It's just the craziest thing, and I just, like, every other day I'm buying a T-shirt online to support a cause or whatever. That's awesome. Or just crazy stuff. So who would have thought?
That's great.
I can't thank all of you enough. We had over 400 people here. I really hope every single person that joined us that took time away from their day walked away with at least a couple of talking points to make them better, to make them smarter, and really appreciate all the panelists for joining us today. Have a great week. Have a safe Tuesday, and we'll see you all soon.
Thank you, guys. Thank you, Jonathan. Thank you, Greg. Thank you, Eric.
Guys, great to chat.
Bye-bye.